In this video, we're going to go over the break-even date change important update. And just to give you a quick breakdown, we're going to go over things like what are important updates, how you can actually receive them, why they're so important to our process as investors, how you can actually use this particular update. Then I'll go over two different examples of the different outcomes for this topic. And lastly, I'll summarize where you can go to do some more due diligence. So for starters, what are important updates? Well, it's basically a brief summary of an important development in the underlying business or the stock that it's referring to. So today we're going to have a look at when a company's expected break-even date changes, like when it's expected to turn profitable, but it could be other topics like when a company releases its earnings reports, or when analysts change their revisions on the company's forecasts, or a dividend change occurs and stuff like that. So how do you actually receive one of these updates? Thankfully, it's very simple. All you have to do is add a stock either to your watch list or to your portfolio, and then it's automatically eligible to receive these important updates. And they will appear either on your dashboard on the Simply Wall Street platform or in your email inbox. So why are these so important to our process as investors? Well, they allow us to monitor the stocks that we're following. And this basically is important because we want to remain informed on the fundamentals of the businesses that we're either interested in our watch list, or the businesses that we actually own in our portfolio. So if a company announces its earnings reports, or the dividend changes, or there's an upcoming dividend, or there's insiders buying and selling shares, these updates are important, right? And as investors, we want to know about them because they can change our thesis on a stock, or they can just basically help us remain informed on the businesses that we either want to own or currently do own. And lastly, they allow us to save time during this monitoring and research phase. So these important updates are a compilation of all the data that's related to that particular topic, and they're sent straight to us. If we didn't have this important update, we would have to go and try and find these insights manually, and that would be reading through the company's quarterly filings or annual filings, and that could really be quite a time-consuming process to read through all those documents and try and find the same sort of insights. These updates help us alleviate all that time-consuming process. So let's talk about the break-even date change update. As I mentioned, it's just basically when there's been a change in the estimated break-even date for a company. So this is covering unprofitable companies, and it's like when analysts show us their future forecasts of earnings, and when they finally think it'll cross from the red into the black when it's going to start making some profits. So this update here, this is an example just on the right, which we'll get into in a second, but this update gives us data on a whole bunch of info on a whole bunch of data. So of course it displays the new expected break-even date. It shows us the previous break-even date. This is just to give us some context of like, okay, when it was previously expected to turn profitable versus now when they expected to turn profitable. The future net income expectation, and that's basically just like the first profit that analysts expected to ever deliver in the year that it turns profitable. The required earnings growth. So this gives us an idea of like, okay, company is currently generating losses now. What is its required earnings growth rate for this break-even date change to come true, right? So you can see here the expectation, or required earnings growth rate is 94% if it is to achieve that profit on schedule. So the reason why we display that is to try and give us some context of like, okay, I go and look at the business, I go and research it, and it's like, do I think the company can grow its earnings or reduce its losses at that particular rate? And then if I look at it and I don't think it's possible, like I think its costs are too high, or its costs are going to increase as it grows, then I may think that kind of earnings growth rate isn't achievable. And so that's why we would display that there. And also the analyst count. So basically this just shows us how many analysts are covering the company, and we do this to show us, okay, here's how many different people have submitted sort of their estimates for the stock. And the more analysts that cover the stock, the more opinions there are, versus like if there's only two analysts covering a stock, it would be like, okay, there's only two people who are providing their input. It's typically the more analysts, the better, because you've got like a bigger sample size to pull from. So let's have a look at two different examples of this outcome. So here we got a break-even date improvement, where like the company's finally like they've got a date for when it's expected to break even. And here we've got a break-even date deterioration, where the first expected break-even date has actually now been revised and pushed out a year. So I'll look at the details here. Forecast to break even in 2025 is the title. So finally, it seems like this company has a break-even date when it didn't actually have one before. The 7 analysts covering the stock expect the company to break even for the first time in 2025. New consensus forecast suggests the company will make a profit of $4.7 million in 2025. Average annual earnings growth of 49% is required to achieve the expected profit on schedule. So just for some context there, what I would have to go and do is try and figure out through all my own research is if I think the company can actually generate the 49% earnings growth per year to generate that break-even date. That's something else I would go and do my own research on. The next example, says forecast break-even date pushed back to 2023. The 11 analysts covering the stock previously expected the company to break even in 2022. So as you can see, it's now they reckon it'll take longer for the company to finally generate a profit. New consensus forecast suggests losses will reduce by 72% in 2022. So previously they expected to finally generate a profit, but now they actually just expect the losses to reduce quite a bit in 2022. The company is expected to make a profit of $5.8 million in 2023. Average annual earnings growth of 94% is required to achieve the expected profit on schedule. So it seems like analysts expect a big improvement in earnings because 94% is quite a lot. And we're in 2022 right now, and they expected to finally generate a profit next year. So some sort of big catalyst has basically going to happen over this coming year where they're finally going to generate more earnings from their business. So let's go do some more digging on this, and I'll show you where we can go. First section I would check out is the price history and performance chart, just to see if there's been any recent news or events and updates that have driven analysts to change their break-even date estimate. So I'd read through these developments here, if they're like product update, but if there was any more recent developments here, I'd have a read just to see if these were the reason they've changed their estimate. Same thing for this company here. If there was a reason why they pushed it out a bit further, maybe increased costs or one-off expenses, stuff like that, I'd have a look at these developments here just to see if anything sort of relates to why they've changed their estimates. The next section I'd have a look at is the future growth forecast section and try and see how they've changed. So as an investor, I try and keep a regular check on this section of the report because as analysts keep changing their estimates, this section of the report keeps changing as well, right? Because it's the consensus of all their estimates. And so I'd have a look at just how the earnings and revenue and free cash flow are sort of trending and how analysts expect them to trend over the coming years based on their forecast. Now we can see here, actually, given it's 2022, this company here is just below free cash flow break even, but it's actually this second company here is generating cash flows and cash flow from operations as it stands right now. So I'll get into why that's important in just a second, but basically I just have a look here for the trends overall and see what the particular earnings lines are trending like to see when they're actually expected to break even. So then I'd have a look at the valuation section and see how the future growth forecasts have potentially changed this estimate of fair value. So also I would keep an eye on this section regularly on the stocks that I'm interested in my watch list or portfolio, just because this section changes as analysts change their estimates, right? Because these valuations are based off analysts' forecasts of the future free cash flows. And so I'd have a look. Ideally, I'd have a rough idea of what these numbers were and if they have changed based on these changes in estimates. And also just it's important to keep in mind, these aren't buy or sell recommendations, but they're just a good indication of what a fair value could be based on certain assumptions and inputs. And so to know what those certain assumptions and inputs are, I'd click the view data button just in this section here, and I'd read more about what the inputs were, like what the expected growth rates are, what the discount rates are, and then based on my own research and due diligence that I've done, I can then determine if I think those are fair inputs or not, and I can go generate my own model on an Excel spreadsheet and see if I agree with it. So the next section I'd have a look at is the past performance section, just to see if it has a predictable track record and if they're currently generating any free cash flows. So given the company isn't making a profit right now, cash flows are very important because there's a difference between cash profits from free cash flow and accounting profits, which is net income or earnings as we're seeing here. Cash profits, free cash flow, are like actual cash generated by the business. It may sound silly, but net income and earnings actually also include non-cash expenses, which is stuff like share-based compensation or depreciation expenses and stuff, which is why we can sometimes see a discrepancy in a company's cash profits versus its accounting profits. And you can see a perfect example here. This business is generating free cash flows right now of about $13 million, but it's actually generating a loss in the income statement on its earnings line. And that looks, I can assume, but I will go and look into it, that would be because of non-cash expenses like depreciation and share-based compensation and stuff. So I'll cover free cash flow in just a second as well in the cash burn situation. So One important point I'd have a look at here as well is the purple line, which is the operating expenses. And operating expenses is stuff like research and development, sales and marketing, general and admin, those kind of expenses. And so I try to see how they are trending versus the company's revenue, right? Because if they're trending exactly in line with revenue, it's very tricky for the company to make a profit, right? And this seems to be the situation here. It's spending like more than it's actually making in sales, whereas this company, its operating expenses actually are pretty in line with how many sales it's generating. So it's like, does it need to spend? It seems like it needs to spend this money to make this sort of money in sales. And so this is concerning given it's spending like virtually as much as it's making in sales, but this might be a high growth company. And for this example here, it might be like, okay, well, it's got like a scalable cost base where it's like, okay, it spends more on its research and development, therefore it makes more money in its revenue and stuff like that. So the next section I have a look at is the financial health section. And this is just to look at like, okay, is there a cash burn situation that is concerning? And is like the company, does it have any leverage? And so this first example, this company here actually has no leverage at all. So it's got $229 million in cash and no debt. So I would have a look at how much that company was generating in negative free cash flow, because that's its cash burn. And it was like negative $5 million for the past year, but analysts actually expect it to like improve and be positive. So once a company is generating positive free cash flows, it's technically self-sufficient, right? Like it is generating excess cash flows than what it needs in its business, like its operating expenses, and it has excess cash flow that it can give to its owners or just retain. And so this particular company, it seems like it's pretty safe, right? It's actually generating enough cash flows. It will be in a second to be self-sufficient, but it's also got $229 million cash on hand should its free cash flow be negative for a bit. So if its free cash flow is a negative $5 million, it seems like it has plenty of years worth of cash saved up to be able to continue run its business unprofitably. This company here is a bit different though. It has $34 million in cash and $19 million in debt. So it's a bit concerning that it has a bit of debt, but it has enough cash flow on hand that it seems like it isn't concerning. Also, what is important to note is it is generating free cash flow right now. So it's generating enough in excess of what it needs, and that's very important because if it was negative free cash flow, that means it would need to potentially raise more capital. And so for unprofitable companies, we have this check in the financial health section called cash runway analysis, and this gives us some more context on that. So these companies, even though they're actually not profitable right now, they actually seem pretty sturdy and secure because of their cash runway. And so this tick here says that this company here has cash runway for more than 3 years based on its current free cash flows, and this company here is the same, has more than 3 years of free cash flow if it maintains its positive current free cash flow level, which we mentioned it's currently generating positive free cash flows. And there isn't enough data for this forecast to tell us if the free cash flows are growing or not. But for this forecast cash run rate here, the company is actually growing its free cash flow by like 52% per year. So it's got more than enough cash to sustain itself. And so this is important, right? Because it's like, okay, the company won't break even in terms of its net income, like its profit, but it's generating enough free cash flows where it can sustain itself. So that's really good to see from like a risk point of view. It doesn't have to both of these companies technically don't have to raise capital via equity or debt. And if it was equity, that could dilute shareholders. There isn't really that much of a risk in these situations because they are generating these free cash flows. So that's pretty much like a brief summary of where I'd go to get some more context on the break-even date change. In summary, I go to the price history and performance chart just to see if there's been any recent updates and events. I go to the future growth section and valuation section just to see how they've changed based on these changing estimates from analysts. I go to the past performance section just to see if the company has a track record of like either generating free cash flows or generating revenues and how those operating expenses have been trending. And lastly, I check out the financial health section just to see if the company has enough cash on hand to meet its needs, if the company's got any leverage that might be concerning, like any debt that might be due soon, and lastly, the cash runway analysis, if the company is generating free cash flow, how many years does it have worth, and if it isn't generating free cash flow, how many years does it have left, like in terms of the cash balance that it has, and how quickly is it burning through cash. So that's what I do to get some more context on the break-even date change update. I hope this video has been helpful. Thank you so much for watching.